Welcome to the VCA podcast, where we explore the strategic shifts, hidden opportunities, and structural transformations reshaping markets, industries, and investment ecosystems. Today, we are discussing a topic that sits at the intersection of finance, technology, regulation, and market infrastructure: the institutional adoption of tokenization. My guest is Gaya Chandrasekaran. Gaya, good morning.
Good morning.
Gaya has over 17 years of experience across corporate banking, investment banking, and wholesale credit risk within global financial institutions. Her career combines front office commercial deal making with senior executive risk management, giving her a deep institutional perspective across capital markets, liquidity, regulation, and financial infrastructure. As distributed ledger technologies begin to reshape market design, her current advisory and research work focuses on institutional tokenization and the evolution of financial market infrastructure. She recently contributed to the Tokenization Playbook 2026 with Evergone Labs and actively participates in industry discussions on digital assets, tokenization, and the future architecture of financial markets. Gaya is also the president of the Alumni Tech Club at the London Business School, where she helps convene discussions on topics including digital assets, tokenization, and the evolving design of financial markets. Gaya, welcome to the VCA podcast. Thank you for joining us today.
Thank you, Christophe. It's a pleasure to be here. I'm really looking forward to our conversation because we are at a fascinating crossroads in financial market infrastructure.
Before we discuss why tokenization has not yet scaled institutionally, let us start with the basics. Tokenization is often mentioned in financial markets, but the term can mean different things to different audiences. From your perspective, what is tokenization really about, and why does it matter for the future of financial market infrastructure?
Okay, so to understand tokenization, we first have to break down what financial infrastructure actually means. The simplest way to think about it is as the invisible plumbing of the financial system. The networks, record keepers, and settlement systems operating quietly in the background every time money or assets move between institutions. Today, when you buy something like a stock or a bond, the transaction may appear to be instant on your screen, but behind the scene, multiple institutions still need to reconcile records, verify ownership, move cash, and formally settle the trade. So that process can take anywhere up to 2 days. One of the reasons blockchain technology started attracting attention in financial markets is because it offered a different way for institutions to coordinate and maintain records across these fragmented systems. What is a blockchain at its simplest? A blockchain is a shared, synchronized digital ledger that multiple participants can view and update at the same time. So instead of every institution maintaining separate databases and constantly reconciling transactions against one another, participants operate from a common ledger, which is a record of ownership and transaction history. And what blockchain technology potentially changes is the ability for multiple parties to coordinate around a shared source of truth rather than maintaining fragmented systems that constantly need updating and reconciliation. And tokenization is essentially what happens when ownership rights to a traditional asset like a bond, fund, or equity, they get represented digitally on top of that shared infrastructure. What's important is that tokenization is not just about creating a digital version of an asset. What really changes is that the asset itself and the underlying settlement infrastructure can begin operating together within the same environment. In other words, the transaction logic, the settlement process, ownership records, and compliance conditions can increasingly become embedded into the infrastructure itself rather than sitting across multiple disconnected systems. And that's why I see tokenization as much more than a technology trend. It represents a much deeper redesign of how the financial market infrastructure operates.
Yeah, tokenization has generated enormous interest, yet adoption still feels relatively early compared with the amount of industry discussion around it. In your white paper, Tokenization at Scale, Institutional Architecture as the Decisive Factor, you argue that much of the visible activity remains stuck at the asset layer. Why is this focus slowing the market down, and where should the real transformation actually be happening?
So, to understand why the market is moving slowly, we first need to understand that financial systems operate across two different layers, the asset layer and the infrastructure layer. So, what is the asset layer? Asset layer is basically the financial product itself. It's the bond, it's the fund, equity, or loan that an investor wishes to have exposure to. And what is the infrastructure layer? That is the underlying financial plumbing that allows those assets to move safely through the system. That includes settlement systems, custody networks, liquidity management, compliance processes, risk controls, payment rails, etc. So these are terms that we will keep using throughout our conversation today because tokenization is all about re-engineering them. But what happened over the last few years is that the market became heavily focused on the asset layer. A lot of energy went into creating digital versions of various traditional assets so they could exist on the blockchain infrastructure. But creating a tokenized asset is no longer the main challenge. The much bigger challenge is whether those assets can actually function within institutional systems of settlement, liquidity, regulation, and governance. And that's where adoption becomes much harder. And because in many cases, institutions are still trying to connect new tokenized assets into fragmented legacy infrastructure that was never designed to operate this way. So instead of removing complexity, many initiatives have ended up simply creating parallel complexities. And that's why one of the central arguments in my white paper is that tokenization is fundamentally an infrastructure transition rather than simply a product innovation. And increasingly, regulators and policymakers are framing it this way as well. For example, the latest joint work from Bank of England and Financial Conduct Authority in the UK increasingly frames tokenization not simply as a new asset format, but as part of a broader evolution in how money, settlement, as well as financial market infrastructure may eventually operate together within more integrated digital environments. Then we have the European Central Bank that has recently pointed out that the real value of tokenization only fully emerges when issuance, settlement, and custody can operate together within an integrated environment. The Financial Stability Board has also made similar observations, specifically around the importance of interoperability between trading and post-trade infrastructure. So I think the industry is slowly realizing that focusing only on the asset layer creates visibility but not necessarily scale. And the real transformation happens when the underlying infrastructure itself begins to evolve.
You highlight a striking contrast in your research. Tokenized bond issuance is now relatively routine, yet it still represents only a tiny fraction of the global traditional bond market. Why are these pilots struggling to cross the chasm into true institutional scale? And did the market initially underestimate the complexity of the infrastructure required?
So I think the market significantly underestimated how difficult it would be to integrate new tokenized systems into, the deeply embedded infrastructure of global financial institutions. And the scale gap we see today really reflects that. recent data from International Organization of Securities Commission, or IOSCO, we will be using these terms throughout the conversation. So showed that tokenized bond issuance globally still amounts to only about $10 billion over the last decade, versus a traditional global bond market of the size of around $140 trillion. And we see a similar picture with the public equities as well, where tokenized equities remain quite tiny relative to the scale of the traditional stock markets. So despite all the attention around tokenization, institutional adoption is very nascent. And interestingly, this came through very clearly in discussions at a recent event organized by Global Blockchain Business Council, or GBBC, at the UK Parliament. Despite strong momentum and institutional interest, there was broad recognition across policymakers, regulators, and infrastructure providers that tokenized markets are still in a relatively early phase, but that the long-term scale of opportunity could be enormous if the infrastructure foundations evolve successfully. And one of the biggest reasons is that many pilots still operate in isolated digital environments. For instance, a bank may successfully issue a tokenized bond on a blockchain, but much of the surrounding infrastructure, such as treasury operations, cash management, reporting, compliance, risk monitoring, etc., they still sit inside traditional banking infrastructure. So instead of simplifying the system, institutions often end up running parallel systems side by side. And that can actually increase operational complexity rather than reduce it. And traditional financial infrastructure, as we all know it, is already quite highly fragmented. And if you look at research from BCG, it estimates that the financial industry spends up to about $24 billion annually on post-trade processing and reconciliation across disconnected systems. And if you look at diagram 1 in my white paper titled The Evolution of Financial Market Infrastructure, which can also be seen on our screen, maps this transition quite visually. On the left-hand side, you have the traditional model where transactions move through multiple separate intermediaries, brokers, custodians, clearing systems, payment networks, etc., often across disconnected ledgers and over delayed settlement cycles. Whereas on the right side, you have the tokenized infrastructure that compresses much more of that life cycle into a shared synchronized environment where settlement, ownership records, and the transaction logic itself can increasingly operate together. So that's really the structural shift institutions are trying to solve for. But scaling that from a control pilot into a globally interoperable institutional network is an enormously complex transition, as is evident from what we've been discussing. And I think that's really the phase the industry is entering now. So we will see what happens.
Yeah, no, it's good. I mean, that you highlight the complexity of that process, because we within Value Creation Alternative have a solution to finance new projects through the issuance and monetization of bonds, but there is an upfront cost, and some of our prospects tend to be surprised by the upfront cost of the process. Now, looking at its complexity behind the scene, we can understand why we need to charge this. One argument we often hear is that regulation is the primary roadblock to tokenization. But your paper takes a different view. You argue that regulation does not necessarily block tokenization. Rather, it reveals whether a system is institutionally ready. Can you explain that distinction?
So it's quite easy to blame regulation for slow adoption, but in practice, the issue is usually much deeper than regulation itself. Most major global standard setting bodies are actually moving towards increasingly technology neutral frameworks. For example, the Basel Committee on Banking Supervision has made it quite clear that if a tokenized instrument represents the same legal and economic exposure as its traditional equivalent, then it should generally receive the same regulatory treatment as the traditional instrument. So the real issue is usually not whether regulators are blocking tokenization. I would say the bigger issue is whether the underlying system architecture is mature enough to operate safely within institutional and regulatory expectations at scale. And that distinction becomes quite visible when institutions move beyond small pilots. In controlled pilot environments, firms can often manage compliance manually. If a regulator requests some data such as ownership verification, transaction monitoring, etc., then teams can still extract information manually, reconcile data in spreadsheets, and apply operational workarounds behind the scene. But once you try to scale those systems into live, high volume institutional environments, then those manual processes become extremely fragile very quickly. And you cannot run global financial infrastructure sustainably on spreadsheets, reconciliations, and operational patches. And that's why I often say regulation functions less as a blocker, it functions more as a readiness test, if that makes sense. And it reveals whether compliance, governance, reporting, risk controls, etc., are actually embedded into the infrastructure itself, or whether they still depend on manual intervention outside the system for this. And I think this is where the market is gradually evolving. The discussion is shifting away from simply asking whether assets can be tokenized and towards much harder questions around operational resilience, governance, interoperability, and institutional trust. Because ultimately, if a platform cannot meet institutional regulatory standards at scale, then that usually tells us the architecture itself, still has a massive gap.
That is an important reframing. If regulation is not the real bottleneck, then compliance, risk management, and systemic control need to be designed into the infrastructure itself rather than layered around it operationally. How should institutions think about embedding these requirements directly into the architecture?
Okay, actually, that's a great question. A key shift happening right now is that compliance is gradually moving from being an external operational process into something that becomes increasingly embedded within the infrastructure itself. Traditionally, compliance sits around the transaction. Like a trade happens first, and then institutions apply layers of verification, reporting, approvals, and monitoring processes afterwards. So that model works in slower fragmented systems, but it becomes much harder to manage efficiently once markets move towards more automated and real-time environments. What tokenized infrastructure potentially allows is a much more programmable approach. Instead of checking compliance after a transaction occurs, certain rules can increasingly become embedded directly into the transaction logic itself. So, for example, we have investor eligibility rules, we have transfer restrictions, we have jurisdictional requirements, or, for instance, you have settlement conditions too. So, all of these can potentially be encoded into the asset and transaction architecture itself. And if those conditions are not satisfied, then the transaction simply does not go through. So that's a very different operating model to what we have now. And we're already starting to see this emerge across different tokenized environments. Within Ethereum-based ecosystems, for instance, we see standards like ERC 3643, which are exploring how compliance conditions can be integrated directly into the tokenized assets itself. And in some of the other environments like Ripple's XRP Ledger ecosystem, certain transfer and authorization controls can be embedded more directly at the ledger level itself. So what becomes interesting at institutional scale is that this shifts compliance away from being heavily dependent on manual operational oversight and towards much more automated enforcement of risk and regulatory rules. And I think that's one of the reasons the discussion around tokenization is increasingly moving beyond the asset itself and towards infrastructure architecture. Because ultimately, institutions are not trying to digitize securities, they are trying to redesign how trust, compliance, and operational coordination function across financial systems.
You often say that digital assets markets are painfully rediscovering basic lessons that traditional finance already learned. When we compare legacy market frictions with tokenized settlement, what are the core laws of capital markets that technology simply cannot bypass? I'm thinking, for example, about liquidity management, collateral mobility, settlement finality, and institutional trust.
One of the biggest misconceptions in technology driven financial discussions, I would say, is the assumption that faster execution automatically reduces systemic risk. That's not true. Atomic settlement is a very good example of that. So, in traditional financial markets, securities and cash often settle across delayed settlement cycles. It's currently typically around T plus 2 days, like 48 hours after the transaction happens. That delay creates counterparty exposure because one party might fail before the settlement completes. But atomic settlement reduces that exposure by allowing both sides of the transaction to settle simultaneously. So, from a credit risk perspective, it is a very elegant solution. But what institutions have quickly come to realize is that instant settlement changes liquidity requirements quite dramatically. So, traditional financial markets, they rely heavily on this mechanism called netting. Throughout the day, institutions offset large volumes of transactions against one another and settle only the net difference later, like net amount owed by one party to the other. That significantly reduces the amount of liquidity and collateral institutions need to hold upfront. But once markets move towards continuous real time settlement or atomic settlement, as we call it, what happens is that flexibility becomes much more limited. Participants may suddenly need much larger pools of pre positioned liquidity and collateral available at all times to keep transactions moving. We see this in an example when the Bank of Japan, made the real-time gross settlement transition on the payment side. That's a good example of this dynamic. While end-of-day liquidity requirements remained manageable, peak intraday demand exceeded 30 trillion yen. Showing how settlement timing itself can become a major systemic constraint. And this is where digital markets are rediscovering why traditional financial infrastructure evolved, the way it did over several decades. We already see infrastructure models emerging that effectively reintroduce clearing, settlement, and collateral optimization functions into the tokenized environments. We have a company called Clear Token, and Clear Tokens work around a central securities depository style architecture for digital assets is a good example of the industry recognizing that scalable tokenized markets, they still require coordinated liquidity management, risk governance, and settlement controls. And global authorities have also been warning about these structural realities. We have the Financial Stability Board that has noted that highly automated real time systems can create sudden correlated liquidity movements during periods of stress. The IMF has also similarly observed that real time margining and settlement environments may require higher liquidity buffers, which can negatively affect balance sheet efficiency. So, technology absolutely changes how we record ownership and execute transactions, but it does not remove the underlying economic realities around liquidity, capital, and institutional trust. And I think one of the most important lessons digital markets are now confronting is this, you know. Uh, so, yeah, we will see again, how things move forward.
Yes, this T plus 2 days, for the settlement, to clear is actually a bridge that a lot of con men and scammers use to embezzle. Sometimes people are just pretending that they made a transfer when actually it didn't happen in in effect. Your white paper suggests that the future of financial market infrastructure will be more hybrid than revolutionary. In practical terms, how will legal custody, risk reporting, and settlement systems realistically coexist with distributed ledger infrastructure? And how can institutions avoid creating even more fragmentation in the process?
So, I have, really thought about this question as well. And the bottom line is that wholesale financial markets are very unlikely to experience a sudden overnight, replacement of the existing infrastructure. So I would say the more realistic path is a layered hybrid environment where distributed ledger infrastructure gradually integrates with the existing custody, risk reporting, and settlement systems. That is because today's financial infrastructure already performs extremely important functions at scale. Custodians safeguard assets, payment systems move money, risk systems monitor exposure, regulatory systems support oversight and reporting. These frameworks have evolved over decades, around resilience, liquidity, institutional trust. I think, the markets have made massive mistakes. We've all had to pay the price for it. So these are all lessons learned over many decades of experience and doing things. The challenge is not simply replacing these systems, it is reducing the fragmentation that exists across them. This is where diagram 2 in my white paper, which is titled Legacy Market Frictions versus Tokenized Settlements, also shown in the screen, becomes important. So the diagram contrasts some of the core frictions embedded within traditional infrastructure against the efficiencies tokenized infrastructure is attempting to introduce. On the legacy side, we have delayed settlement cycles, reconciliation across multiple systems, capped liquidity, manual operational processes, as well as counterparty exposure. On the tokenized side, the potential improvements include near-time settlement or atomic settlement, shared ledgers, improved collateral mobility, automated execution, and reduced exposure. But the key point is that tokenization only creates real efficiency gains if these improvements operate across the broader financial life cycle rather than as isolated digital pilots. If tokenized assets still depend on fragmented payment rails, disconnected reporting systems, and separate operational processes, then institutions simply end up adding another layer of complexity rather than removing it. And this is exactly why the future is likely to be hybrid rather than, revolutionary. We are already seeing this direction emerge through initiatives like Project Agora, led by Bank for International Settlements, alongside 7 major central banks and major global commercial banks. The project is specifically exploring how tokenized commercial bank money and central bank money could operate together within more integrated programmable settlement environments. That broader institutional shift is also reflected in BIS research, showing that around 94% of central banks globally are now exploring some form of central bank digital currency infrastructure. So the conversation is no longer about digital settlement infrastructure matters. The real question is how these new programmable systems can coexist safely and interoperably with existing monetary and financial infrastructure at institutional scale. And ultimately, avoiding fragmentation becomes less a technology problem and it is more a infrastructure coordination challenge. That's how I would frame it. The future will depend on interoperability, common standards, and the ability to connect tokenized infrastructure into the systems institutions already rely on rather than creating isolated digital islands.
In your research, you map a structural shift from fragmented risk to programmable risk infrastructure. What does the market still misunderstand about scalability when it comes to changing the underlying architecture of risk, dependency, and institutional control?
So, what many institutions are now realizing is that programmable infrastructure changes not only how transactions move, but also how risk itself behaves across systems. So, in traditional financial institutions, risks are often distributed across separate institutional layers. A custodian manages custody risk, a clearinghouse manages settlement risk, a bank manages credit risk, or credit exposure. Operational dependencies are typically fragmented across multiple entries and systems, but programmable financial infrastructure changes that architecture fundamentally. So, what happens is once transactions, compliance, logic, collateral movements, and settlement rules become embedded directly into the shared digital infrastructure, then risk also becomes far more interconnected. institutions are no longer assessing counterparty creditworthiness or asset value. They also need to evaluate the resilience of smart contract logic, governance permissions, validator structures, cybersecurity dependencies, key management frameworks, as well as operational controls embedded across the infrastructure itself. And we are already starting to see specialized institutional risk frameworks emerge around these new dependency layers. We have companies like Particular, which has developed programmable risk passports for tokenized assets that assesses areas such as smart contract security, governance structures, and operational dependencies. Particular recently partnered with Layer 0 as well, an interoperability protocol designed to help different blockchain networks communicate and operate together. And this collaboration explores how this type of risk intelligence can move across blockchain environments, which become increasingly important as markets evolve towards more interconnected and cross chain infrastructure. And because these systems are increasingly automated and interconnected, vulnerabilities can propagate much more quickly across the network. And that is why I would say scalability is not simply a technical question about transaction throughput, it's fundamentally a governance and control question. And can institutions understand and manage the layered dependencies operating underneath these systems when markets come under stress? Now, that is where the market still underestimates the complexity involved. And global regulators are increasingly focused on these issues as well. We have IOSCO that has repeatedly highlighted governance, operational resilience, key management, and smart contract vulnerabilities as critical areas that institutions still need to mature before tokenized infrastructure can scale safely. And this links directly to one of the broader themes in my white paper. As markets become more programmable, risk management itself also becomes increasingly programmable. And the future challenge is not simply digitizing financial products, it is designing infrastructure where trust governance, operational resilience, as well as control mechanisms can scale alongside automation.
Looking at the design choices institutions face today, what does successful and scalable institution adoption actually look like over the next few years? What should we expect to see from the institutions that move beyond experimentation and start building durable infrastructure?
Successful adoption over the next few years will likely look like institutions gradually integrating tokenized infrastructure into more core financial operations. And we already are seeing such strong momentum building towards that shift. Recent industry surveys suggest around 87% of financial institutions are actively exploring tokenization in some form, while the tokenized real world asset market has expanded by nearly 300% over roughly the last 2 years, just over 24 months. But scaling successfully will not simply be about issuing more tokenized securities. Institutions that move beyond the experimentation phase will be the ones that treat tokenization as infrastructure strategy rather than product experimentation. And that means focusing on how money, collateral settlement, liquidity, and reporting operate together across the full financial life cycle. One concept gaining significance in this discussion is the idea of unified ledgers. At a very simplified level, a unified ledger refers to an environment where tokenized securities, commercial bank money, and potentially even central bank money can interact within more integrated programmable infrastructure rather than across fragmented systems. And that matters because a large amount of capital today remains operationally trapped across disconnected settlement systems, custodians, and collateral pools. When institutions can move assets, cash, and collateral more seamlessly across coordinated infrastructure, the potential efficiency gains become much more significant. Research referenced within my white paper points to estimates suggesting that reducing these types of frictions could eventually unlock up to almost $1 trillion from about $3.5 trillion of posted collateral in the global derivatives market by eliminating duplicate collateral requirements, optimizing excess margining beyond stress tested requirements, and liberating trapped collateral stuck in transfer pipelines. But I think the deeper shift is not just operational efficiency. I think that tokenization gradually will allow financial infrastructure itself to become more synchronized, programmable, and interoperable across institutional networks. And ultimately, institutions that scale successfully will probably not be the ones building the most experimental technology. Uh, it will be the ones that build infrastructure capable of integrating trust, liquidity, and governance, as well as operational resilience, into programmable financial systems at scale.
For the institutions listening who genuinely want to move past the pilot phase, your paper outlines a very pragmatic diagnostic framework. What are the critical questions that risk, finance, technology infrastructure, and operations teams should be answering now? In particular, how should they think about balance sheet efficiencies, capital drag, collateral mobility, and operating model readiness?
So, the practical test is whether tokenization has moved from innovation activity into institutional operating design. So, once you move beyond small pilots, tokenization stops being purely a technology initiative. It becomes a balance sheet, liquidity, governance, and infrastructure question across the institution. And that is the purpose of the diagnostic framework in the final chapter of my white paper. It helps institutions assess whether they are genuinely building scalable infrastructure or simply running, contained experiments. The first area is balance sheet efficiency and liquidity design. If markets move towards more real time settlement environments, institutions need to understand the funding implications very clearly. Can they support higher intraday liquidity demands and collateral pre funding requirements without creating excessive capital drag or balance sheet inefficiency? That would be the key question to ask under this topic. Then the second area is collateral mobility and risk coordination. Can collateral move dynamically across different systems, custodians, and networks when markets come under stress? Or does liquidity remain operationally trapped inside fragmented environments? The third area is interoperability and infrastructure integration. Does tokenized infrastructure connect properly into existing treasury systems, payment rails, risk engines, custody frameworks, and reporting architecture? Or are institutions simply creating another isolated digital silo that still depends on manual reconciliation and operational workarounds? The fourth area is operating model readiness. Do operations team have the governance structures, technical capabilities, and the control frameworks required to manage programmable infrastructure at scale? That includes smart contract governance, key management, operational resilience, and real time exception handling. Because scalable tokenization is not achieved when a pilot transaction succeeds, it's achieved when institutions can operate these environments safely, consistently, and efficiently under real world market conditions. And this is where the industry conversation is moving now, away from experimentation alone and towards long term institutional operational readiness.
Gaya, thank you very much for joining us today and for sharing such a clear institutional perspective on tokenization. What would be your closing remark?
Thank you very much, Christophe. Honestly, I think this is an incredibly important moment for financial markets because the discussion is gradually becoming much more mature. The conversation is shifting away from simply asking whether assets can be tokenized towards much deeper questions around liquidity, settlement governance, interoperability, and institutional trust. So, my hope is that the research helps institutions think more carefully about the infrastructure foundations required for tokenization to scale safely and sustainably over the long term. So, thank you again for the opportunity. I really appreciated the discussion today.
Thank you, Gaya, for being my guest. What I find especially important in your work is the shift away from the superficial question of whether tokenization is technologically possible towards the much more strategic question of whether the institutional architecture is ready. This is highly relevant for banks, asset managers, infrastructure providers, regulators, and investors trying to understand where the real value and the real constraints actually sit. Thank you again for being with us on the VCA podcast.